Nvidia's latest quarterly results showcased exceptional growth, setting the stage for strong near-term momentum. In the fourth quarter of fiscal 2025, Nvidia reported record revenue of $39.3 billion, a 78% jump year-on-year. Data center sales, fueled by demand for AI chips, hit $35.6 billion in Q4 alone, reflecting unprecedented appetite for Nvidia's GPUs from cloud providers and enterprises. This earnings blowout has made better-than-expected results almost routine for Nvidia, according to Morgan Stanley analysts. Importantly, Nvidia's guidance indicates the growth trend will continue in the very near term. For the current quarter, management forecasts revenue of $43 billion, which is above Wall Street expectations. Gross margins are projected around 70 to 71%, slightly down from recent levels due to product mix and cost, but still extremely high for the semiconductor industry. In effect, Nvidia is guiding to sequential growth on top of last year's massive surge, implying little sign of an immediate slowdown. Despite these strong fundamentals, stock market reaction to the Q4 report was cautious. Nvidia's shares dipped about 3% after earnings. The tepid response reflected the lofty expectations baked into the stock after its 2024 rally, where shares nearly tripled. Investors appeared to be expecting more from the AI darling, a reminder that in the short term, even record results can trigger profit-taking if they merely meet and not beat sky-high hopes. This dynamic is a near-term risk. Nvidia is priced for perfection, so any hint of disappointment can spark volatility. On the flip side, upcoming catalysts in the next couple of months could renew bullish sentiment. Nvidia's annual GPU Technology Conference featured CEO Jensen Huang hinting at exciting things to come beyond the current Blackwell chips. Such management commentary, combined with potential new product announcements, can keep traders excited in the short run. Wedbush Securities highlighted that Nvidia's recent results showed few, if any, blemishes and that there is seemingly only good news ahead, maintaining an outperform rating. In other words, near-term news flow, from product launches to further big customer wins, remains a catalyst that could push the stock higher. However, traders must also watch for policy news in the immediate term. In early April 2025, the U.S. government imposed tighter export controls on Nvidia's AI chips to China, a development that hit the stock. Nvidia revealed it must halt sales of its H20 data center GPU to China without a license, and as a result, will incur a $5.5 billion inventory charge in the first quarter. This announcement sent Nvidia shares down about 6% in after-hours trading and contributed to a roughly 25% drop in Nvidia's stock price early in 2025. The export restriction is a short-term risk overhanging the stock. It directly reduces Nvidia's sales in the coming quarter and injects uncertainty about future China revenue. Any further government actions or headlines on this front could cause quick stock moves. For instance, signs of U.S. authorities softening their stance or granting export licenses might spark a relief rally, whereas talk of additional tech curbs could pressure the stock again. In summary, Nvidia's short-term outlook is bolstered by stellar earnings momentum and strong guidance, indicating demand remains red-hot into the next quarter. Exciting product news and continued AI investment by customers act as immediate catalysts. Yet, traders should remain cautious about near-term risks, the stock's high bar for earnings surprises, and external factors like export regulations. Midterm outlook: 3 to 12 months sustained AI demand versus emerging headwinds. Looking over the next 3 to 12 months, Nvidia's fundamental story is centered on sustained, even accelerating, demand for AI hardware. On the demand side, all indications point to a continued AI gold rush in the tech industry. Major cloud platforms and tech companies are massively boosting capital expenditures to build out AI infrastructure. Meta plans up to $65 billion in data center spend for 2025, Alphabet around $75 billion, and Amazon over $100 billion. A substantial portion of these budgets is earmarked for AI and machine learning deployments, effectively meaning buying Nvidia GPUs and systems. Nvidia's order backlog and product ramps underscore how extraordinary the midterm demand is. The company's newest data center GPU line, codenamed Blackwell, achieved billions of dollars of sales in its first quarter of availability. In fact, Nvidia disclosed about $11 billion in revenue from Blackwell in the latest quarter, the fastest ever product ramp in its history. CEO Jensen Huang described the demand for Blackwell as amazing, noting that AI customers are essentially buying all the supply Nvidia can produce. Supply chain improvements should gradually unlock more sales. Nvidia itself is investing heavily alongside partners like TSMC to scale production, including plans to build up to $500 billion worth of AI servers in the US over 4 years. For 2025, the effect is that each quarter's results could sequentially grow if supply constraints ease, given the apparent order pipeline. Crucially, AI demand is broadening from just model training to the much larger realm of model deployment, or inference. Huang emphasized on the earnings call that reasoning models can consume 100 times more compute than prior generation AI. New AI applications require significantly more processing power to run. Huang noted the vast majority of Nvidia's current demand now comes from inference workloads rather than one-off training of models. This perspective suggests that through 2025, AI adoption will remain a strong catalyst for Nvidia. While the demand picture is overwhelmingly positive, Nvidia's midterm horizon isn't without risks and challenges. A key concern is how export restrictions and geopolitical factors will affect Nvidia's business. The US government's decision to curb sales of Nvidia's H20 AI chips to China is a meaningful setback. China accounted for around 13% of Nvidia's $130.5 billion revenue last fiscal year. After initial US export controls in 2022, Nvidia engineered modified chips to continue selling to Chinese customers. The new rule closes that avenue. Any advanced GPU now needs a license for China, effectively pausing those sales. In the midterm, this could create a 10 to 15% dent in revenue if no alternative routes are found. Nvidia is absorbing the hit via a one-time charge and will likely redirect many H20 units elsewhere. Demand ex-China is so strong that Nvidia can reallocate supply with minimal financial loss. Those H20 chips were lower-spec products for China. Now the capacity can be used to make higher-end chips that cost 2 to 4 times more per unit. Chinese customers also have limited alternatives to Nvidia in the near term. Domestic efforts, such as Huawei's AI accelerators, are constrained by China's lack of access to the most advanced chip-making tools. As a result, even with US sanctions, Chinese firms desperately need Nvidia GPUs, and a sizable black market for Nvidia chips has already developed in China. Another area to watch midterm is the competitive landscape. Advanced Micro Devices, AMD, is launching its MI300 series accelerators to compete in AI data centers. AMD's data center segment revenue jumped 69% year-over-year to $3.86 billion in Q4 2024, driven by MI250 and MI300 chips. Early benchmarks indicate AMD's GPUs achieved 1.4 to 1.8 times higher throughput on popular models in specific scenarios. Over the next few quarters, cloud providers like Microsoft Azure are testing AMD's MI300 in their AI infrastructure. If AMD secures major deployments, it could start nibbling at Nvidia's share. Nvidia's midterm risk here is not an immediate loss of leadership, but rather the beginnings of pricing pressure or minor share loss. Big Nvidia customers are developing in-house silicon that may become viable within the next year. Amazon's AWS already offers its own Trainium chips, Google advances its TPU hardware, and Microsoft is reportedly testing an internal AI chip codenamed Athena. While none of these proprietary chips will outright surpass Nvidia's performance immediately, they reduce the incremental demand for Nvidia in those ecosystems at the margin. Supply chain execution remains a midterm watchpoint. Nvidia's ability to meet demand through 2025 depends on manufacturing partners like TSMC and suppliers of advanced packaging. Earlier, supply was a bottleneck. Nvidia is expanding capacity and even testing chip production with Intel's foundry process for potential future use. Over the next 3 to 12 months, if Nvidia can successfully ramp output, it could translate to upside beyond current revenue forecasts. In essence, the midterm looks very favorable for Nvidia's fundamentals. Catalysts include relentless AI-driven growth in spending by customers, new product ramps like Blackwell GPUs scaling up, and potentially improving supply enabling Nvidia to book more sales. Long-term outlook, 1+ year future growth path and competitive position. Beyond the next year, Nvidia's long-term thesis remains anchored by the idea that we are in the early stages of an AI-driven computing revolution spanning many years. CEO Jensen Huang has articulated a vision that AI is transforming every industry and successive waves of innovation will require exponentially greater computing power. Future AI models will need 100 times more compute due to their complexity and reasoning abilities. This implies that even after the current surge, demand for Nvidia's advanced GPUs and AI platforms may continue growing rapidly for years. Nvidia is already planting seeds in new areas like autonomous machines, robotics, edge devices, and enterprise AI applications. Nvidia's ecosystem and innovation engine serve as long-term competitive moats. The companies are and amp winking and laughing spending jumped 50% last year to over $11 billion. Nvidia directs these funds toward a full-stack solution, not just chips, but also software frameworks, AI models, and hardware systems. This holistic approach makes Nvidia's platform hard to displace. Developers worldwide are trained on CUDA and Nvidia AI libraries. New competitors must match not just chip performance, but also the entire software ecosystem to displace Nvidia. Moreover, Nvidia continually leads in launching new architectures roughly every 2 years. After Blackwell, the next-generation GPU architecture is expected to leapfrog competitors once again. Nonetheless, long-term risks remain. Competitors like AMD, Google, and Amazon are aggressively improving their hardware. Cloud giants in-house silicon will mature further. Even new entrants could emerge with novel architectures. There is also the risk that the explosive AI investment moderates. Corporate IT budgets are not limitless. After a period of heavy AI infrastructure build-out, a digestion phase is possible where companies consolidate what they've built rather than keep adding GPUs at breakneck pace. Some analysts caution that by 2026 growth rates may normalize, making year-over-year comparisons tougher. Regulatory risks are another long-term factor. Nvidia's dominance could invite antitrust scrutiny, or future geopolitical tensions could restrict its international growth. Macroeconomic factors, including a potential recession, could slow data center spending temporarily. Nonetheless, Nvidia's long-term prospects remain bright if it executes well. Under the leadership of CEO Jensen Huang, Nvidia is expanding into new markets like CPUs for servers and networking systems. This broader platform approach could significantly grow Nvidia's total addressable market over the next decade. Wall Street's highest price targets, such as $220 from Rosenblatt Securities, reflect confidence that Nvidia will continue to grow into its valuation. Even the average analyst 12-month target around $165 suggests robust growth expectations. In summary, short-term traders can expect powerful earnings and news catalysts. Medium-term investors are looking at sustained growth driven by AI spending, and long-term stakeholders see a company with unparalleled positioning to capitalize on the AI revolution.